Welcome to our weekly show focusing on the key macro trends affecting FX and the broader markets. Today we're going to look at one of the most important factors for those global markets, which is central bank balance sheets and how their direction of travel in 2026 could impact FX. And all this is on the back of last week's FOMC, where Chairman Jerome Powell indicated that having completed quantitative tightening on December the 1st, the US Federal Reserve might now restart a program that could look a lot like quantitative easing and start expanding the balance sheet once again. Along with delivering the expected quarter-point rate cut, many believe that these actions will improve liquidity conditions in 2026, potentially boosting risk assets. And now that all sounds great, but if carried through, the actions of the Federal Reserve could significantly diverge from other major central banks. And that's because for the last couple of years, most of the major central banks have been reducing the size of their balance sheets simultaneously, including the European Central Bank, the Bank of Japan, as well as the Federal Reserve. If now, however, the Fed is loosening whilst others are tightening, then the hope for improvement in liquidity from the US is not necessarily a layup for risk assets, because the Fed's actions could be offset by those other central banks. In fact, liquidity could tighten into next year, which obviously would be a negative. But this divergence might provide some opportunities in the currency markets. The Bank of Japan, for instance, is expected to hike rates in the December meeting. And if they also indicate that balance sheet runoff will continue or even accelerate, then Japan and the US could be following very different paths. And this could benefit the yen. But that would actually be a slightly contrarian view after the steady march higher in the dollar versus the yen over recent years. But with the broad-based dollar index coming under a bit of pressure in recent sessions, the yen may now be primed for a period of relative strength. And the point is that liquidity is not just an absolute story, but also a relative one. And the relative conditions in early 2026 could be significantly different from the ones of just a few weeks ago. And this could be beneficial to the yen. And with that, now let's look at some of the questions we've been getting from our viewers.
Okay, so first up, should I be looking at silver rather than gold?
Obviously, gold has been one of the stories of the last 2 years, making multiple new highs. But in recent weeks, we've seen silver break out and absolutely accelerate higher. So we need to therefore look at their relative performance. When we look at the ratio of gold versus silver, gold has been underperforming, but the ratio is still only at the midpoint of the long-term range, and that suggests that silver can continue to outperform. But remember, silver is much more volatile than gold, so you have to be prepared for bigger P&L swings when taking positions in silver.
The next question is, will emerging markets outperform in 2026?
Well, the answer to this one is very much dependent upon the performance of the US dollar. You see, over the last 25 years, the S&P 500 has generally underperformed emerging markets when the dollar was declining, like 2002 to 2010. And the S&P has outperformed when the dollar was rising. Therefore, if the US is pursuing looser conditions relative to other regions, the dollar can continue to fall. And that outcome should be supportive of emerging markets relative to the US equity market. But for emerging markets to truly outperform, we'd probably need higher yields in the US, which then could undermine the tech stocks that have delivered so much of the US outperformance in recent years.
And our final question is, will 2026 be more challenging than 2025?
Well, for equity investors, 2025 has been a remarkably serene year once April's tariff tantrum had been fully digested. Now, it won't be easy to replicate that strong performance next year, and so by default, we should therefore expect more challenges. But for crypto investors, however, this has been a challenging 12 months, with Bitcoin currently down on the year. For 2026, the debate is raging about whether the 4-year cycle or the business cycle will dominate. And that's a program in itself. But performance will largely hinge on liquidity. And as we've just discussed, the US is about to prime the pumps, and the rally in many commodities suggests that liquidity will be plentiful. But that might mean inflation will be a problem. Because high yields are a headwind for crypto. We should, however, embrace the fact that crypto assets are volatile. Volatility may create challenges, but it can also create exciting returns. But just be careful with leverage, because we always feel the pain more than we feel the gain. Okay, that's it for this week. But before I close, please remember that none of this is investment advice. It's for education and engagement purposes to help you with your own research, and when investing, please understand your own risk tolerance, time horizon, and investment objectives, and then invest accordingly.